What if the global economy collapsed overnight? What if the US entered a recession and the domino effect crushed entire countries? It may sound extreme, but the truth is, many nations are standing on the edge, relying on the US for survival. Some depend on American trade, while others have built their economies on US investments and exports. When the US stumbles, these countries could completely collapse. The world has seen a multitude of significant events recently, and today we're going to delve into some of the most impactful ones shaping our global landscape. We'll examine the intricate connections between nations and how disruptions in one major economy can send shockwaves across the planet. Stay with us as we explore these critical developments, and remember, we'll be drawing some important conclusions towards the end of the video. Your support is incredibly important for the growth of our channel. Please consider liking this video and subscribing if you find our content informative. Also, let us know where you're watching from in the comments below. We love hearing from our global audience. You might think that Mexico is safe from the impacts of a US recession, but guess what? You'd be shocked at how deeply connected these two economies really are. With billions of dollars in trade flowing between the US and Mexico every year, a sudden economic downturn in America would devastate Mexico's economy. In 2023, around 80% of Mexico's exports went to the US, with cars, electronics, and agricultural products leading the charge. Consider the sheer volume. Hundreds of billions of dollars exchanged annually. This isn't just a casual trade relationship. It's a fundamental pillar of the Mexican economy. A significant drop in US consumer demand, a hallmark of any recession, wouldn't just slow things down. It could send Mexico into a devastating downward spiral. The factories producing goods primarily for the American market would face order cancellations, leading to production cuts and, inevitably, job losses. You'd be surprised how quickly that could lead to rising unemployment across various sectors, from manufacturing hubs in the north to agricultural regions further south. The consequence? Widespread poverty, potentially erasing years of economic progress and destabilizing communities. But that's not all. Mexico's growing dependence on remittances from the US has also become a lifeline for many families. These are funds sent home by Mexicans working in the United States, often supporting basic needs like food, housing, and education for relatives back in Mexico. If US wages decline or jobs are lost during a recession, these vital remittances would slow to a trickle. The impact would be immediate and severe, leaving entire communities struggling to survive. Imagine families suddenly unable to afford essentials, small businesses losing customers, and local economies grinding to a halt. The combined effect of reduced trade and dwindling remittances paints a grim picture. The result? A country potentially pushed onto the very edge of collapse, facing not just an economic crisis, but a profound social one as well. The interconnectedness, while beneficial during prosperous times, becomes a significant vulnerability when the larger economy falters. Mexico's fate, in many ways, remains intricately tied to the economic health of its northern neighbor. Please make sure to watch the entire video, as we'll be summarizing the key takeaways and offering concluding thoughts at the end. What if Canada's reliance on the US economy was the reason its own survival is at risk? You'd be shocked at just how dependent Canada is on its southern neighbor. The United States is Canada's largest trading partner, with approximately 75% of Canadian exports heading south. This relationship encompasses a vast array of goods and services, forming the bedrock of Canada's economic activity. But if the US falls into a recession, Canada's economy would be in big trouble. A slowdown south of the border immediately translates into reduced demand for Canadian products. You'd think Canada could survive on its natural resources alone, like timber, minerals, and especially oil. However, the truth is that even oil prices are closely tied to American demand. A slowdown in the US economy would inevitably push oil prices down. This is because the US is a massive consumer of energy, and when its industrial activity and consumer spending decrease, its need for oil diminishes, impacting global prices. For Canada, particularly provinces heavily invested in the oil sands like Alberta, this would mean a massive hit to its crucial oil sector. Lower prices reduce profitability, leading to cuts in investment, exploration, and production. This downturn in the oil sector could also mean significant job losses, not just directly in the energy industry, but also in related support services and manufacturing. Furthermore, the economic pain could trigger a housing market crash, especially in regions heavily reliant on the resource sector, as declining incomes and job insecurity make it harder for people to afford mortgages. You might think Canada's strong social systems, like employment insurance and health care, would buffer the population from the worst effects. While these systems provide a safety net, the sheer scale of the economic strain caused by a severe U.S. recession could overwhelm them. Reduced tax revenues and increased demand for social support would put immense pressure on government budgets. This economic strain could push the country toward a broader financial crisis, potentially requiring drastic austerity measures or leading to increased national debt. Millions of Canadians could find themselves scrambling for stability in an environment of uncertainty and reduced opportunity. Could Canada truly survive economically without its deep U.S. ties? Given the sheer volume of trade and investment, and the integration of key sectors like energy, it's not likely. The economic destinies of the two nations are profoundly intertwined. Have you ever wondered how vulnerable a tech giant like South Korea could be to a U.S. recession? You'd be shocked by how interconnected their economies are. South Korea is the home of global powerhouses like Samsung and Hyundai, companies whose names are recognized worldwide. A vast portion of their exports, particularly in high-tech goods, head straight to the U.S. market. In 2023, more than 14% of South Korea's gross domestic product came from exports to the United States alone. This reliance is especially pronounced in the electronics and automotive industries. These sectors are pillars of the South Korean economy, employing millions and driving innovation. But what happens when the U.S. economy falters? A sudden recession in the U.S. would dramatically reduce the demand for South Korea's products. American consumers and businesses would cut back on purchases of smartphones, televisions, cars, and appliances, precisely the goods South Korea excels at producing. The semiconductor industry, which is South Korea's biggest single export and a critical component in countless electronic devices, would face a severe downturn. American tech companies, major buyers of these chips, would inevitably slash their budgets and reduce orders as their own sales forecasts decline. You'd think that would only be the beginning, right? The fallout wouldn't just affect the tech sector, it would ripple across the entire South Korean economy. Reduced exports lead to lower corporate profits, decreased investment in research and development, and potentially massive job losses, not just in large corporations but also in the extensive network of suppliers and smaller businesses that support them. This could lead to widespread economic instability. The financial strain resulting from decreased export revenue and corporate cutbacks could lead to a collapse of consumer confidence within South Korea. As people worry about job security and their financial future, domestic spending would also likely decline, further deepening the economic downturn. This creates a dangerous feedback loop, triggering an economic domino effect. Imagine an entire nation of tech-savvy individuals, accustomed to economic dynamism, suddenly facing layoffs, stagnant wages, and rising inflation due to a lack of export demand. South Korea's economic engine, heavily reliant on global trade and particularly the U.S. market, would stall. Furthermore, the ripple effects could extend to other East Asian economies that depend on South Korea for components, or as a market for their own goods, demonstrating the regional interconnectedness. Would South Korea survive a severe recession in the U.S. unscathed? Given its heavy export orientation and reliance on the American market for its key industries, it's a ticking time bomb. What if Brazil, the largest economy in South America, could be taken down by something as simple as a U.S. recession? You'd be shocked to learn that Brazil's economy is far more dependent on the U.S. than you might think. Brazil's exports to the U.S. include everything from soybeans and iron ore to oil and manufactured goods. This diverse trade relationship forms a significant part of Brazil's economic foundation. But when the U.S. catches a cold, countries like Brazil often face a full-blown economic flu. In 2023, over 20% of Brazil's exports went to the United States. This substantial figure means any significant reduction in U.S. demand would have catastrophic effects on Brazil's economy. A U.S. recession translates directly into lower demand for Brazilian commodities and manufactured products. The agricultural sector, which relies heavily on American trade for items like soybeans and coffee, would face a steep decline in profits as U.S. buyers cut back. Similarly, demand for industrial inputs like iron ore would diminish. With unemployment already a persistent issue in the country, a sudden downturn in trade would only exacerbate poverty and inequality. Reduced export earnings would strain businesses, leading to layoffs and further concentrating wealth, potentially fueling social tensions. But wait, the shockwaves wouldn't stop there. Brazil's government debt has skyrocketed in recent years, leaving the country vulnerable to any external economic shock. If the U.S. enters a recession, global commodity prices, including crucial exports like iron ore and oil, would likely fall. This would severely hit Brazil's oil exports, which have become increasingly important to its trade balance. Lower commodity prices reduce government revenues and make servicing the national debt even more challenging. This combination of falling export demand and lower commodity prices would put enormous pressure on the Brazilian real, the national currency. A sharp devaluation is possible, which could lead to rampant inflation as the cost of imported goods rises. This, coupled with job losses and reduced government spending capacity, could trigger widespread social unrest. Imagine a country already struggling with significant inequality and unemployment, facing a sudden, externally triggered economic collapse. Could Brazil pull through such a scenario? Its reliance on commodity exports and its high level of government debt make it highly uncertain. The economic health of the U.S. casts a long shadow over Brazil's prospects. What if India's massive outsourcing industry came crashing down because of a U.S. recession? You'd be shocked by how much India depends on the U.S. for its economic stability. The truth is, India's booming tech and service industries rely heavily on American contracts. In fact, nearly 60% of India's IT sector revenue comes from the United States, making it incredibly vulnerable to downturns in the American economy. So, what would happen if the U.S. went into a recession? A sudden slowdown in the U.S. economy would lead American companies to slash their IT budgets and cut back on outsourcing non-essential services. And guess what? That would directly hit India's job market, especially in major tech hubs like Bengaluru and Hyderabad, where millions rely on tech outsourcing for their employment. With less money flowing from the U.S., Indian IT companies would be forced to reduce salaries, cut jobs, and halt expansion projects. The result? A potential massive economic crisis for millions of Indians who depend on this sector for their livelihoods. But that's not all. India's economy is also heavily dependent on remittances from Indian workers abroad, many of whom are employed in the U.S., particularly in the tech and healthcare sectors. If the U.S. economy crashes, the flow of money back into India would dry up. This loss of income would leave families struggling, unable to afford basic necessities, and push more people into poverty, further straining the social fabric. Imagine the ripple effect across the country. Fewer jobs in the lucrative IT sector, reduced income from remittances, declining consumer spending, and increased pressure on government resources. Could India handle such a multi-pronged economic assault? While India has a large domestic market, its reliance on the U.S. for high-value service exports and remittances makes it particularly susceptible. It's not likely it could escape unscathed, especially considering its existing challenges with poverty and unemployment. The country's fragile economic balance could be severely disrupted. Have you ever wondered how a U.S. recession could devastate Turkey? You'd be shocked to learn how interconnected Turkey is with the American economy. Turkey's economy is already fragile, grappling with high inflation often exceeding 50% and a weakening currency, the lira. In fact, due to these underlying weaknesses, it's considered one of the most vulnerable emerging markets to an economic collapse if the U.S. hits a recession. So how could this happen? Well, Turkey's export market is heavily reliant on the U.S. for everything from textiles and automotive parts to machinery and agricultural products. A downturn in the U.S. economy would significantly reduce demand for Turkish goods, sending the country's export-driven industries into a tailspin. Reduced exports mean lower profits for Turkish companies, leading to job cuts and decreased investment. But that's just the start. Turkey also depends heavily on foreign investment, particularly from the US and Europe, to finance its current account deficit and support its currency. During a global recession, risk aversion increases, and investors tend to pull their money out of perceived riskier markets like Turkey. American and other foreign investors would likely withdraw their capital, seeking safer havens. This capital flight would put immense pressure on the already weak Turkish lira, potentially leading to a sudden and sharp devaluation. A collapsing lira pushes inflation even higher, as imported goods become prohibitively expensive. This creates a vicious cycle of economic decline, eroding purchasing power and potentially leading to widespread social unrest as the cost of living skyrockets. You might think that Turkey's strategic location between Europe and Asia would help it survive economic downturns by diversifying its trade partners. However, the truth is that the country's deep reliance on American trade, capital inflows, and even tourism means that a U.S. recession could cause it to spiral into even deeper financial chaos. What happens when inflation skyrockets further, unemployment rises sharply, and public discontent reaches a boiling point due to economic hardship? Turkey could face a severe economic crisis with the potential for significant political instability. Can Turkey survive without the U.S. lifeline? Given its current economic fragility and dependence, the answer isn't so clear. Have you ever wondered how a country with a history of economic struggles like Argentina could get even worse in a global downturn, particularly one triggered by the U.S.? Argentina is a prime example of what can happen when an economic giant like the U.S. hits a recession. You'd be shocked at how much Argentina depends on external factors for its survival. Argentina's economy has been in turmoil for years, with inflation soaring over 100% annually, and the peso rapidly losing its value against major currencies. Despite these chronic issues, the country still relies heavily on exports like soybeans, corn, wheat, and beef, many of which are sent directly or indirectly to the U.S. market, or markets heavily influenced by U.S. economic health. If the U.S. faces a recession, global demand for these agricultural commodities would likely plummet as overall consumption decreases. This drop in demand and potentially lower commodity prices would severely impact Argentina's export revenues, which are crucial for bringing in foreign currency. But the problems run deeper. Argentina carries a massive burden of foreign debt, largely denominated in U.S. dollars. The country has a long and painful history of defaulting on its obligations. A U.S. recession would make accessing new credit infinitely more difficult. With U.S. banks and international financial institutions tightening their belts and becoming more risk-averse, securing the loans needed to roll over existing debt or finance government spending could become impossible for Argentina. This raises the terrifying prospect of another sovereign debt crisis. Imagine the government defaulting on its obligations yet again. This could trigger hyperinflation, completely wiping out savings and making basic goods unaffordable. It could lead to massive social unrest and political instability, further crippling the economy. You might think that a country like Argentina, having faced crises before, would be able to handle it. But the truth is that its reliance on external trade, particularly commodity exports sensitive to global demand, and its critical need for foreign debt financing, make it extremely vulnerable. What happens when Argentina's ability to pay back its loans is compromised due to falling export revenues and lack of access to credit? The country could face a complete economic meltdown, far worse than its previous crises. Argentina's situation is a ticking time bomb, and a U.S. recession could set off the chain reaction that sends it into even deeper financial turmoil and social chaos. The potential for collapse is frighteningly real. Can you imagine a world where Saudi Arabia, the powerhouse of the Middle East and the world's largest oil exporter, crumbles because of a U.S. recession? You'd be shocked at just how deeply Saudi Arabia's economy depends on the U.S. market and global oil prices, which are heavily influenced by U.S. economic activity. Saudi Arabia's oil exports make up over 90% of its government revenue, and the vast majority of its total export earnings. The U.S. has long been one of the kingdom's biggest customers for crude oil. Now, imagine this. What happens when the U.S. faces a significant economic downturn and its demand for oil takes a nosedive? If the U.S. cuts back substantially on oil imports due to a weakened economy, Saudi Arabia would lose a significant chunk of its revenue stream almost overnight. And guess what? That's just the tip of the iceberg. A U.S. recession often triggers a global economic slowdown, further reducing worldwide demand for oil and causing prices to plummet. With oil prices falling and export volumes shrinking, Saudi Arabia's entire financial system could face immense pressure. You might think that Saudi Arabia could rely on its massive sovereign wealth fund and financial reserves to weather the storm. However, the truth is that oil isn't just their main export. It's the absolute backbone of their entire economy and government funding. Without a steady flow of substantial revenue from oil sales, Saudi Arabia could face a massive financial crisis. Imagine a kingdom that has spent billions on ambitious projects like NEOM and other Vision 2030 initiatives aimed at diversifying its economy, only to see its primary funding source drastically reduced. What happens when government revenues plummet, forcing drastic cuts to public spending and subsidies that citizens rely on? What occurs when unemployment spikes, particularly among the youth, and social unrest begins to take hold in a country accustomed to oil-fueled prosperity? Saudi Arabia could find itself facing a crisis of unimaginable proportions, challenging the very stability of the kingdom. The reliance on a single commodity, even one as critical as oil, tied so closely to the health of the U.S. and global economy, presents a profound vulnerability. Have you ever wondered how a country with such vast resources and potential like Nigeria could crumble under the weight of a global recession, especially one originating in the U.S.? Nigeria is one of those nations teetering on the edge, and the prospect of a U.S. recession could be the tipping point into chaos. You'd be shocked by how much Nigeria relies on global trade, and, critically, its oil exports to maintain its economy. But here's the kicker. Nigeria's economy is extremely vulnerable to the whims of the global oil market. Oil makes up more than 90% of Nigeria's export revenue and a huge portion of government income. A large portion of this oil historically goes to the U.S. market, or is priced based on global benchmarks heavily influenced by U.S. demand. So, when the U.S. faces a recession and demand for oil drops globally, Nigeria's economy takes an immediate and severe hit. Oil prices fall, and export volumes decrease, slashing the country's main source of foreign currency and government funds. Without the cash flow from oil exports, the Nigerian government could struggle to fund essential public services like healthcare, education, and infrastructure projects, triggering an economic crisis that could send the country into chaos. You might think Nigeria's challenges stop there, but its economy faces extreme poverty, high unemployment, especially among its large youth population, rampant corruption, and significant political instability, including security challenges in various regions. A recession in the U.S. would exacerbate all these problems. Furthermore, many Nigerian workers rely on remittances sent from abroad, including from the U.S. If the U.S. economy weakens, these financial lifelines could dry up, plunging families further into poverty. Imagine the ripple effect across Africa's most populous country: fewer jobs, higher inflation eroding already low incomes, increased poverty, and a growing sense of unrest and desperation. In short, a U.S. recession could plunge Nigeria into a full-blown economic disaster. With its fragile infrastructure, political instability, and overwhelming reliance on oil, the country may struggle immensely to recover. Could this be the breaking point? The answer might surprise you with its severity. Have you ever stopped to think about how the world's second-largest economy, China, might be affected by a U.S. recession? China, which has enjoyed decades of rapid export-fueled growth, could find itself in serious trouble. The reality is shocking. China is heavily dependent on the U.S. for its manufacturing and exports. In fact, China exports nearly $450 billion worth of goods to the United States every single year. This trade relationship has been a cornerstone of China's economic miracle. But what happens if that trade lifeline is cut off or severely restricted? In the event of a U.S. recession, consumer demand for Chinese goods would inevitably take a nosedive. American households and businesses would tighten their belts, reducing purchases of everything from electronics and clothing to furniture and toys manufactured in China. Consequently, China's manufacturing sector, the engine that drives its economy, would suffer a severe slowdown. This could trigger widespread consequences: rising unemployment as factories lay off workers, numerous factory closures, and an overall slowdown in economic growth, potentially stalling decades of progress. But that's just the beginning. China is also heavily reliant on American investment. Many U.S. companies have significant operations and investments within China. If U.S. companies pull out or scale back their investments due to global economic uncertainty stemming from a recession, the financial impact could be catastrophic for China's economy. Furthermore, China is already facing a massive internal debt crisis, with corporate and local government debt levels skyrocketing after years of credit-fueled expansion. The Chinese government and businesses have borrowed extensively to fund infrastructure projects and maintain growth. A recession would make it even harder to service this enormous debt, potentially leading to defaults and a financial crisis. Imagine the scenario. A country that has thrived on rapid expansion suddenly hit with a multifaceted economic crisis, shrinking export markets, reduced foreign investment, and an internal debt bomb threatening to explode. It's not just the loss of the U.S. market that's a concern. A U.S. recession would also mean reduced global demand for China's exports overall, as countries around the world tighten their belts. This puts even less business in the hands of China's manufacturers and places further strain on an already fragile economic situation, exacerbated by demographic challenges and a troubled real estate sector. How long could China keep its economy afloat under such immense pressure? With rising debt, weakening demand, and uncertainty ahead, China's economic future might not be as secure as it once seemed. A global shift in economic power could be on the horizon. Wow, it's clear that the economic instability caused by a potential U.S. recession could bring devastating consequences for some of the world's largest and most influential economies. The intricate web of global trade, investment, and finance means that a downturn in the United States wouldn't remain contained. It would inevitably spread, creating a domino effect with potentially catastrophic results worldwide. From oil-dependent nations like Saudi Arabia and Nigeria, whose government revenues and entire economic structures rely on global energy demand heavily influenced by the U.S., to global manufacturing hubs like China and South Korea, whose factories churn out goods primarily for the American consumer, the vulnerabilities are stark. Developing economies like Mexico, Brazil, Turkey, India, and Argentina face a double threat: reduced demand for their exports and diminished access to crucial foreign investment and remittances, potentially pushing them towards debt crises, hyperinflation, and social upheaval. Even developed economies like Canada, despite strong social safety nets, are not immune due to their deep integration with the U.S. market, especially in key sectors like energy and manufacturing. The ripple effects are undeniable. The question remains, will these countries be able to withstand the shock, implementing necessary reforms and finding new avenues for growth? Or will they collapse under the immense pressure, potentially reshaping the global economic and political landscape for decades to come? The interconnectedness that fueled global prosperity for decades now reveals its inherent fragility. If you found this video insightful and want to stay informed about critical global economic trends, please subscribe to our channel, like this video, and share it with others. Your support helps us continue to provide eye-opening content like this. We're committed to bringing you more analysis on the economic dangers facing nations worldwide. Thank you for watching.